Thank you for joining us for Fed Watch. Today is Friday, October 13th, and there are really three things I want to cover today. We're going to talk about the minutes being released about the September FOMC meeting. That won't take too long. I want to talk about the jobs report that came out for September, and tangentially what the CPI has to do with all of that, and then what really is going to matter going forward in our opinion. So let's talk about the FOM, the Federal Open Market Committee meeting minutes. The minutes were released from the September meeting, so they're about a month dated. What I noticed in the meeting minutes was that they seem to acknowledge that credit conditions have tightened, but they also go on to say that the economy remains very robust. People are getting all the credit they want, both businesses and individuals. And they remain vigilant about inflation. So I was surprised at the little bit of disinformation there about credit availability. And I think the fact that they see the economy still being very strong is subject to redefinition as we round the bend into 2024. For instance, the jobs report, which is items number 2. That a lot of people looked at went, whoa, because the headline number reported out by most of the media was up 336,000 jobs in September. And that was like, wow, didn't see that coming. And it was stronger than ADP had reported. I talked about that last week, what ADP had to say. And I was surprised by the strength of that number also. So I started tearing it apart. First of all, that's a seasonally adjusted number, and we use not seasonally adjusted data at ITR. We find that it's cleaner. No one's running through any statistical filters. We can compare it to prior years, same month, very easily. It's not all that difficult. So when I did that, lo and behold, the private sector actually declined by 399,000 jobs, just under 400,000 jobs lost due to layoffs and or discharges over the course of September. That's a radically different story than that headline number. And I said, well, where did all the jobs come from that were in that headline number? And the answer there is government. Government added, all levels of government, not just federal, added 984,000 jobs in September. So, you know, I look for productivity. In ITR, we deal on the private side of the economy, private enterprises. So we look at private sector. The headline number includes government, which is legit. I understand it. But when we break it down to our clients, the picture is a lot weaker. And going back to the minutes, there was nothing in the Fed minutes acknowledging the slowing down in manufacturing, the rising trend in layoffs, which I also parsed, and that data is only through August, but there's a very clear rising trend going on in the level of layoffs. The year-over-year percentages in layoffs aren't astonishing yet, but the slope of the trend is clearly stronger than normal, all of which tells us we are indeed heading toward that softness in 2024, which ultimately, despite the September CPI being stubborn at 3.7%, is going to allow the CPI to come down, is going to provide some maneuvering room for the Federal Reserve to lower interest rates in 2024. That's how we see these numbers taking shape. So does it matter if the Federal Reserve is going to raise interest rates again in November? No. And the pundits right now are saying that it's more likely going to be December than November. I really don't care if it's November or December. I don't really care if they go up another 25 bips. That's just them following through on what they said they were going to do. Their real issues are the tightening credit conditions and how that's going to spread through the economy. We've become even more aware over the last week about pressure on corporate profitability. That's a very serious issue for the economy. And that layoff trend, which wasn't cited in the Fed minutes, is a significant trend also. Remember, we're forecasting 1Q 2024 real GDP will come in below the fourth quarter. So we readily acknowledge, yep, it's going to continue to rise GDP through the rest of 2023. But it's when the Fed sees 1Q 2024 weakness, which they won't see until 2Q 2024. I don't know how they're going to do anything but contemplate lowering interest rates or at least holding the line. Long-term bond yields, government continue to be very high. All we need is a 100 basis point decline in the Fed funds rate for us to get back into a normalized yield curve. That can be accomplished without a great deal of difficulty over the course of 2024. That's how we see it going down. Keep your eye on manufacturing new orders, which are in negative territory. Keep your eye on overall capacity utilization rates in the industrial sector. That is in negative territory. These are important tells. They're not going to necessarily matter to the service sector, but they clearly matter to the industrial sector. We'll see you next week. Thank you for watching this edition of Fed Watch.